Hello, everyone. Hope everyone is doing well. Starting to warm up. Sun is coming out more, so instant mood booster. But today we're going to talk about navigating your 401k rollover options. We're going to actually give a short market overview first, and then talk about some industry statistics, and then just some different options with rollovers. This presentation is a lot of fun. Some of the industry statistics around forgotten 401k plans is truly mind-boggling. But my name is Brett Sebion. I am part of the Emerge 360 team. Emerge 360 is a division of TrustPoint. Emerge 360 provides education services for the TrustPoint 401k plans, and we also do financial planning and investment management outside of 401k plans, similar to what TrustPoint has always done, just working with a wider group of individuals. So I've been at TrustPoint for about going on 7 years. Started out in the investment department, and then hopped over to the Emerge team when that was started about 4 years ago. So just a little background on TrustPoint and Emerge, kind of in general. We've been around for over 110 years, and we've been headquartered in La Crosse, Wisconsin that entire time. We also have offices in Minneapolis and Eau Claire. All in all, about 100, 105 staff members. These are all of our services that we provide in the top right. So the majority of what TrustPoint does is work with individual clients, providing investment management, financial planning, tax planning, estate planning services. We also administer 401k plans. We work with about 200 different companies administering their 401k plan. We also work with a lot of foundations and nonprofits in the communities we serve. So on the individual side, or total client relationships, we have about 1,200. And we manage about 3,700 separate accounts. And when you combine all of the monies that we manage for the services that we provide, it's about 8 billion of AUM. So the agenda for today, current market update, because markets have been very volatile. So just wanted to give a quick update on that and remind people that these types of environments do happen, and it's always important to maintain a long-term mindset. 401k industry statistics. So this is, again, very mind-boggling. I'm excited to get into this with everybody. What is a rollover? What are your options, benefits of a rollover, and how can Emerge 360 and TrustPoint help? So current market update here. So this is an environment that has happened very quickly. Kind of the peak to trough in the stock market decline. It's actually an environment that is, I think, taught investors a good story, which most market corrections do. But the story I think we can take away from the one we're experiencing is that diversification matters, right? The mix between your stocks, bonds, and cash has never been more important today than it has been in the past. So these numbers are through March, so they look a little bit worse because the beginning of April was very bad, but we've since rebounded a little bit. Global stocks are really only down around 2.5, 3.5%. Through March, they were down 1.8%. The story to take away from this slide is that really U.S. markets have felt the brunt of this sell-off. We've seen U.S. large cap growth down about 10%, currently down around 11.5, 12.5%. U.S. small cap has even been a little bit worse, but the shining spot in equity markets has been international stocks, and that has really not been the case for the last 10 years. So we've seen kind of a rotation out of the U.S. stock market and into the international stock market. So again, diversified portfolios, not having all of your eggs in one basket can really help shield people from when we experience this market volatility. So that's on the equity side. Fixed income markets or bond markets, which a lot of people have exposure to, especially the older they get. You want to have more of a conservative allocation. You don't want to be 100% invested in the stock market. So you're going to have some bond market exposure. And the fixed income market generally has done what it's supposed to do relative to the stock market volatility. Fixed income markets had a poor April, but through March, most areas of that market were positive. And again, interest rates spiked in April, which put downward pressure on the price of most areas of the bond market. But they still haven't gone down as much as the stock market, right? They're providing that shield from the stock market volatility that we're experiencing. So yes, it has been a bumpy road. There's definitely certain areas of the market that have experienced it more, i.e., US stocks compared to international stocks and fixed income markets. So, want to emphasize it is important to have a diversified portfolio. And then just a couple long term market slides. We really discourage people from timing the market. So, this slide is titled Missing Even the 10 Best Days in the Market. Reduce your returns meaningfully. So if you would have put $100,000 into the market in 1993, the S&P 500, all the way through the end of 2023, your 100,000 would have turned into 1.8 million. But if you would have missed the 10 best days in the market, the days the market is up 6, 7, 8%, doesn't happen very often. But when it does, we want to make sure we are invested in those days. Because if you miss the 10 best days, you can see your 1.8 million went all the way down to 800,000. Now, that's still a good return, 100,000 to 800,000, but you missed out on $1 million because you were not invested in the 10 best days because you were trying to time the markets. And you can see as you miss more and more of the best days, the ending value of your investments continues to go down. So even missing one of the best days will have an impact. It's not that hard to miss one or two or three of the best days over longer periods of time. So we want to make sure that that we're invested in the market. We don't try to time markets, so we don't miss some of those single best days. Another great example of the cost of trying to time the market. So if you would have put 10,000 in the S&P 500 at the end of 1959 and you were invested all the way through the end of 2023, that one $10,000 investment would have turned into 5.1 million, basically a 10 to 11% annualized return. The reactionary investor, which is what I want to talk about, in the red, they moved 100% of their investments into 90-day treasury bills every time the market dropped 30%. And then 2 years later, they put everything back into the market. So they're trying to time markets, get everything out, and get back in when they felt like it was comfortable enough to do so. So the market drops more than 30%, 1, 2, 3, 4, 5, 6, 7 times over this time period. The reactionary investor, instead of having 5.1 million at the end of the day, if they would have just did nothing, ended up with 600,000 by taking money out of the market and trying to time the markets by going back in. So two good examples of the cost of trying to time the market. It may work once or twice, but even one mistake over 10, 20, 30, 40 years is really going to have a negative impact on your portfolio. So just wanted to spend the first couple minutes on a market overview. Things will get better. They always do. I feel for folks who are maybe retiring next year or just retired and the anxiety is a little higher. But markets are cyclical. So it's important that you have an asset allocation that you feel comfortable with that aligns with your financial goals. So on to rollover. So I wanna kick this section off by talking about industry statistics, and they truly are incredible. So as of May 2023, it was estimated there were 29.2 million left behind or forgotten 401k accounts, representing 1.65 trillion with a T in assets. That actually represents 25% of all 401k plan assets. This is crazy to me. It continues to go up, and people continue to kind of forget about where they have a 401k, or maybe it was at an old employer that got sold or changed providers, and we'll cover that. But in absolute terms, there are 1.65 trillion in assets that are just left or forgotten about within 401k accounts. The Great Resignation, which came after COVID, it resulted in a record 45 million Americans changing jobs. This created a 20% increase in forgotten 401k accounts, which is one of the biggest jumps we've ever seen. The BLS, or Bureau of Labor Statistics, estimated that a little less than half of those jobs had active 401ks that they were participating in or had out there. So the net result of all of that was a huge jump in forgotten 401ks in 2021 and 2022, and that total was about 8.2 million. So that really contributed to the increase of what we saw, the great resignation, a lot of people changing jobs or retiring early, etc. So there's an opportunity cost to this. And some of you may or may not know some of the rules and regulations around 401ks when you leave an employer, et cetera. But many forgotten 401k accounts under $5,000, and now that will actually be bumped up to $7,000, are usually transferred into a money market type IRA account. And what that means is that if you're invested in a money market, that's a huge trade-off of not being invested in the stock market or even bond market, which traditionally performs better than just your standard money market account. So again, if you know, in 2025 now, if you leave an employer and it's under $7,000 and you don't do anything with those monies, it more than likely is going to automatically move to a holding account or an IRA account that's only invested in the money market. The other opportunity cost is fees and just general asset allocation. So fees are very important. It's important to know what you're paying, what your fund investment costs are, right? The expense ratios of what you're invested in, because all of that adds up. So this is kind of an extreme, you know, scenario, but it tells a pretty good story. So let's say you're age 35, you have $55,000, and it's a forgotten 401k account, and it's in money market because maybe you jumped out of the market, and you didn't get back in, and now it's just kind of sitting there. It's also being exposed to a above average fee level within the 401k industry at 0.85%. So assuming those are your fees, an annual growth rate of 2.5%, that 55,000 still grows, but ends up being a little over 90,000 at age 65, 30 years later. Now let's take the flip side of that example, a well-allocated, low-fee IRA or 401k. So yearly fees of about 0.4%, but the annual growth rate of a little over 9% because it's invested in various areas of the stock market. That $55,000 starting balance turns into, you know, $750,000 at age 65 or 30 years later. So this is a huge opportunity cost. And, you know, the balances, the starting balances, the money examples that we're using, they can really be whatever they want. The story still stays the same, that you really want to look out for this stuff. You really want to know what the opportunity cost of not doing something with an old account that you may have out there. So how do I find my old 401k? I think if someone is very you know, motivated and is able to accomplish this, creating some type of database that people can go into would be a great scenario, and it would be a great thing for people to use as a resource. But that currently does not exist, not that I know of, that really captures all different types of plans. But the best way to go about trying to find your own 401k is to contact your old employer, contact your old 401k provider, and look for old 401k paperwork, or look at an old email that you maybe would have signed up for electronic statements. Those are really the three kind of most effective ways as we stand today that you can go forward with. So we can help, you know, clients with this, and we have in the past, and participants. But these are kind of the three main ways to go about that. So what is a rollover, and what are my options? So a rollover, defined by the IRS, occurs when you withdraw cash or other assets from one eligible retirement plan and contribute all or part of it to another eligible retirement plan. Eligible retirement plans for rollovers include 401k plans, 403b plans, money purchase plans, qualified retirement plans, and traditional IRAs. So those are individual retirement accounts. You should be able to, not all the time, transfer a traditional IRA into another qualified retirement account, an employer-sponsored plan. A Roth IRA, you cannot transfer into a qualified retirement plan, an employer-sponsored plan. Even if you have Roth in that 401k, you cannot transfer a Roth IRA into the 401k. That is one rule that the IRS has, that you cannot roll over one type of account. What are your options? Want to break it down into kind of three separate ones, and I apologize, it says number one twice here. But you can basically withdraw your 401k assets when you leave an employer. That is called the distributable event. We almost never recommend this for a few reasons. If you need the money, you need the money, and there are certain circumstances where that may be true. But let's say you have $50,000 in your 401k, you leave an employer, you're 50 years old, you decide, I'm just going to take that out as a cash distribution. Anything that is pre-tax of that 50,000, maybe the entire thing is pre-tax, meaning you have not paid taxes on that yet. When you take that as a cash distribution, you now need to claim all of that as ordinary income. Okay, so it's going to be a tax bill. If you're under the age of 59 and a half, you're also going to pay a 10% penalty on taking a cash distribution. So your $50,000 is now going to be, $30,000, $35,000, not to mention the opportunity cost of not leaving it invested in the market and letting it work for you. Second option is leave your money in a former employer's 401k plan. This is sometimes recommended, not a bad idea. It's still being invested more than likely in a capacity that is benefiting your future. The third option, roll your assets into a new 401k or an IRA. This is usually recommended, and we'll talk about the benefits of doing so. Again, the option one with withdrawing cash out, a lot of this I kind of explained in the slide before, but really the big disadvantages is the penalties and fee and the forfeit of future growth, where your funds may not be available for your future kind of retirement. Again, want to reiterate, distributions included in your current year, it's taxable income in that year and may result in taxation at a higher tax bracket. It might catapult you higher into the next tax bracket. But really, the main advantage would be immediate access to cash if you were to need it at that time. Leave your money with a former employer's plan. The advantages of this are familiar investment choices, right? Maybe you've been there for 5, 6, 7, even more longer in years, and you're comfortable with the investment options. You like how they've performed. You're comfortable with them, etc. And really, it's continued tax deferred growth, right? It's still being invested in your future, in the capacity to benefit your future self. Disadvantages may not allow for Roth conversions. Some people are motivated by that. Some 401ks have that option. Some 401ks don't. There might be a minimum balance required. So again, if it's under that $7,000 and you don't do anything, they are more than likely going to move that to an IRA that is only invested in the money market account. So if it is under 7,000, you really are incentivized to move that to your new employer plan or roll to an IRA. You may also have limited withdrawal strategies. Again, some of these are just sorry, I can't say it right. Within different 401k plans, the specifics with how they work. Benefits of a rollover, and this is really all encompassing of option 3. One of the main things I always like to encourage folks is that it's for simplicity, right? It's easier to keep track of, especially if you've changed jobs a lot. When I go out and do a lot of education for the Trust Point 401k plans and give presentations, and I always say, I understand I'm saying, yes, roll it to Trust Point, right? And that's benefiting Trust Point. But if you were to ever leave and go to another company where Trust Point isn't the administrator, that's just one account you have to move forward with, right? So it really does simplify things so that you don't forget about one or two that you had, maybe decades earlier. Avoid any unexpected provider changes. This is a great point, right? Because I can tell you, working with plans and having relatives and family members and other plans, friends, it's not uncommon for a company to change 401k providers, or if a company gets sold and is bought up by another company, they just go with that new provider, right? So again, this is a thing that happens often and something to take into consideration. Potential cost savings, administratively or investing related. So fees are important to take a look at. not just the fee that the plan is being charged, but also the investment options inside of the plan. They might have hidden fees within, inside of them. And sometimes this isn't as transparent on a statement. So we're always happy to look at statements for folks to let them know exactly what they're paying, if the investment options have any hidden fees, etc. So that is option three. One we usually encourage people to do for the simplicity fact. Avoid any unexpected provider changes if the company gets sold, or if the new 401k administrator comes in, and then just the potential for cost savings. Benefits of rolling over to an IRA. So one of the biggest reasons you would want to do this, most reasons I should say, or most people would this would be the biggest benefit of working with someone in more of an advisor capacity. So let's say that it's you're at your time in your life where you want to start working with an advisor, you want more investment management advice, you want to go through financial planning, tax planning, etc. Rolling to an IRA and working with an advisor, this would be a good opportunity to do so, because chances are you've accumulated some monies within an employer plan, right? So when you leave an employer, you have the option of rolling it over to that IRA. I will also say if you're 59 and a half and you're looking for financial advising, advice or investment management advice, you can do an in-service rollover to an IRA, and we've seen people do that as well. The option to convert traditional dollars to Roth if you're motivated to do so, and really just better communication overall, right? Because in theory, you're working with an advisor instead of part of an employer plan. So you should be getting that advice that you need and are paying for. So how can TrustPoint help? So TrustPoint and Emerge 360, a lot of what we do is working with individuals, providing investment management advice, financial planning, tax planning, etc. We do have an investment relationship minimum of $50,000. It's not per account, that's just per relationship. So IRAs, joint accounts, broker accounts, maybe you received an inheritance, a divorce settlement, you downsized your house. Those are all kind of different examples where we can administer different types of accounts. Or maybe you have 4 old 401ks out there that combine to $50,000 or more. They can all be consolidated into 1 or 2 different IRAs, depending if it's traditional or Roth. And at that time, you start receiving more advice on the investment side, on the financial planning side, etc. So we have our full kind of menu of services. So the benefits of moving into an Emerge account or into an IRA in general: independence from former employer, greater investment flexibility and control. Maybe you're invested in a bunch of different ways in the 4 or 5 different accounts you have out there. Maybe getting that streamlined and getting it into an objective that works towards your goals and kind of what you want out of a retirement type account. Work with a certified financial planner. So TrustPoint has a team of certified financial planners, or CFPs. It's part of our investment management service to go through goals, distribution strategies, social security analysis. The biggest thing, especially when it comes to, you're nearing retirement or in retirement, you've gotten used to getting a paycheck your whole life, you've saved. Now it's time to start paying yourself back as you're not receiving a paycheck, right? And you have different buckets of money. You have pre-tax, Roth, maybe you have brokerage money, pension, maybe you have a cash bucket as well. What's the most tax efficient way to take those distributions to make sure you don't have to, pay any more tax than you need to? Let's say you need $20,000 for a new vehicle. What is the most effective way to take from your retirement accounts for that specific goal, or funding for grandkids, college education accounts? That's all incorporated within the financial planning that we do for our individual clients at TrustPoint and Emerge 360. Again, Emerge 360, like TrustPoint, operates in the fiduciary capacity, meaning we have to act in the best interest of our clients, and we have to be 100% transparent with fees. So everyone at TrustPoint is hourly or salaried. We don't charge a commission. We don't use investment products that give us a kickback for putting clients into certain things. We charge an investment management fee, and all of our services are wrapped up into that. So we're truly incentivized to provide the services we tell you we're going to provide, not by the investments that we hold within client portfolios. Couple housekeeping items. Feel free to sign up for our monthly newsletter, where we have just different content around different financial planning, investment related topics. You can scan here to sign up. We come out with different webinars throughout the year. I think that's on the last slide. I'll leave this slide up for a couple seconds. But we have a bunch of different content out there covering different areas. So feel free to sign up for that for your benefit. And then just like today's webinar, we have webinars throughout the year. And if you're signed up for our newsletter and sign up for our content, you should get reminders of this. Otherwise, you can sign up for the next webinar in May on retirement readiness. And then in August, we have financial questions you're afraid to ask. We have another retirement readiness and rollover planning webinar as well later on in the year. So that is all I have. Tried to keep it within a half hour. Appreciate everybody signing on. I imagine it was over most people's lunch hour. But I am happy to answer any questions offline. Please reach out to us. Our email is there, our phone number is there. Happy to set up a meeting to connect on anything, whether it's outside accounts, investment related, etc. So appreciate everybody taking the time. Please follow us on social media, sign up for the future webinars, and hope to see you down the road. Thanks, everyone.